Hi, I'm Kep Kepner CPA here in Dallas. We're talking today about one of my clients. I'm calling him alias Roger. He earned $900,000 last year and had to pay $300,000 in tax, including about $15,000 of penalties because he was late paying and late filing. So he was upset about that, and we were talking about his strategies. So one strategy that makes sense is for him to take that profit and reinvest it in his business. So if you reinvest in your own business, you would do that because at some point you think you can sell your business. Now, there are a lot of people out there that have businesses that they really are not going to be able to sell them. Let's say you're a marketing consultant, you got your own consulting company, you're going to make $200,000 a year and you go out and do your consulting activity. You're not going to be able to sell that business for much of anything because it doesn't have any value outside of you. However, alias Roger is in a business that could be sold to somebody else. So when you sell a business, you generally are going to get a price that's some multiple of earnings. So if you made $900,000 in profit, maybe you're going to get 3 times earnings, let's say. Okay, so that's $2.7 million. Maybe that's plenty. On the other hand, if you double your profits, which means you're going to pay more tax, if you double your profits, maybe instead of getting 3 times earnings, now you're at 5.4 million in profit, and you get 5 or 6 times earnings. So you end up getting a higher multiple for your company. So for some businesses that can be sold, then those businesses can reinvest their profits back in themselves. Now, there's a real strategy to this. It's not enough to just say, well, I want to sell my business. You have to strategize what you're doing. And the goal of building your business so you can sell it includes setting your business up so that you don't have to run it, so that somebody else can step in and run that business. So that means your customers are being serviced by a sales force. They're not being serviced by you, Roger. You're not the only one who's talking to the customer. You have a sales force to do that. Your vendors are supplying the company. They're not doing it based on you, the owner. They're based on the company and the longevity that they have serving that customer, you, and getting paid timely. You're not doing all the work, so you've developed processes and systems and procedures and computer programs all to manage that whole process. And as you manage that work, then you are not indispensable to the business. So somebody can buy it and feel good that they can step in where you left off. That gives your company more value. So one strategy for alias Roger is to live on less than his after-tax profit. So in his case, he made $900,000, paid $300 in tax, has $600,000 left. Now his challenge, he needs to live on less than $600,000 a year. Okay, I know some of you are listening to that thinking, well, I could do that. I'm only making $25,000 a year. Well, I want to tell you, I have this same discussion with people like you that owe $5,000 because that $5,000 is really dear to you. But in Roger's case, he needs to live on less than $600,000 and take the remainder and reinvest in his business to grow the size and value of his business. So if you need help strategizing how you reinvest your after-tax profits, give us a call because we can help you with that. Thanks.